Welcome to Morris Money, where we talk about some of the most interesting small cap stocks in under 5 minutes. I'm your host, Morris Money. Today, we're talking about an artificial intelligence company that could be on the verge of some massive returns. Shares of small cap ad tech company PERI Network were moving in the opposite direction after its fourth quarter earnings reported on February 7th. The stock tumbled 20% as its revenue growth guidance was on the lighter side for 2024. PERI predicted revenue of $860 million to $880 million this year, representing an organic growth rate of only 10%, which reflects a slowdown in video advertising that's taking place across the industry. However, savvy investors may want to buy the dip on this ad tech stock. The company is making a number of moves in AI that should pay off over the coming years. PERI is best known for its intelligent hub that connects ad buyers and sellers and optimizes purchases and placements. That technology relies on machine learning algorithms, but PERI's work in generative AI could prove to be even more exciting. A few months ago, the company launched Wave, an audio advertising platform that uses generative AI to narrate ads. This allows ads to be customized according to time, place, target audience, and even variables like the weather. Using such technology is cheaper at scale than using human voice actors, and according to PERI's data, it gets better results than traditional ads with 2.4 times the visit rate lift and 117% the incremental sales lift. The technology has been embraced by retailers like Albertsons and Pep Boys and is available on leading audio platforms like Spotify, SiriusXM Radio, and iHeartRadio. It's also one of a number of strategies the company is implementing that has led to its revenue in retail media soaring. Sales in that segment rose 196% in the fourth quarter to $20.2 million. Another new invention for PERI includes a program that shows ads on linear and streaming TV when a viewer pauses a program they're watching. It's currently running that program in partnership with DirecTV. Finally, the company also closed on another acquisition in the fourth quarter, spending $100 million to take over Hivestack, a full-stack programmatic digital out-of-home ad company. Hivestack's technology helps place ads on digital billboards and other outdoor media spaces. The deal gives PERI a presence in a fast-growing ad channel in which it has been underrepresented. Now, let's talk about why the stock could start soaring. There are a number of factors that could give PERI a strong tailwind over the next few years, starting with the growth of AI and the company's own investments in it will make ad targeting better and increase returns on investors for marketers, thereby encouraging more spending on ads, which of course will help PERI. With its investments in the Intelligence Hub, Wave, and Sort, its cookieless tracking technology, PERI is well positioned to capitalize on the AI boom. There's also a general recovery in digital advertising taking place as the recession that many had expected never happened, and brands are starting to ramp up ad spending. PERI also aims to continue making acquisitions which could grow the business and increase its competitive advantages as it works towards becoming a one-stop ad tech shop. Perhaps most of all, the stock looks like a good candidate to go parabolic because it's significantly undervalued. Trading at a PE ratio of less than 11, a steep discount to many of its peers, even though it has a track record of strong growth. Looking at price targets for the company and analyst expectations, currently you have 6 analysts covering the stock with 2 giving it a hold, 2 giving it a buy, and 2 giving it a strong buy, with the average price target at $32.80, representing a 41% upside from this point. Even with low price targets at $25, you pretty much have upside, I wouldn't say guaranteed, but analysts expect guaranteed upside from these prices. Now, I'm going to bring the question to you. Do you think PERI has room to run? And do you think that this AI ad space has room to run more so? Do you think you could see strong returns here, or do you think PERI will fade out with the AI trend? Let me know in the comments down below. Now, taking a look at the broader markets, I found this article from MarketWatch provided by Dow Jones commenting about the volatility of small caps, stating, "A volatile stretch in small caps is just an opportunistic rotation into the lagging sector, rather than investors betting on a strong U.S. economy with looser credit conditions," says one strategist. U.S. small cap stocks looked ready to take off this year after a mostly lackluster 2023, but volatility greeted investors over the past week as uncertainty on when the Federal Reserve will cut interest rates crept back on Wall Street after a mixed batch of January inflation data. The small cap benchmark Russell 2000 Index RUT, which measures the performance of 2,000 small and mid-sized companies included in the Russell 3000 RUA Index, on Friday booked its seventh straight session with a move of at least 1% in either direction, its longest such run since a 10-session streak that ended in March 2023, according to Dow Jones market data. For the week, the Russell 2000 advanced 1.1%, outperforming the tech-heavy NASDAQ Composite, which fell 1.3% by the widest margin since the week ending December 15th of last year. Additionally, the S&P 500 fell 0.4% for the week, while the Dow Jones Industrial Average was off by 0.1%. With all three major large-cap indexes snapping 5-week winning streaks according to Dow Jones market data. The Chief Investment Officer at CBiz Investment Advisory Services, Anna Rathbun, apologize if I butchered that name, commented, "Small caps are almost directly a Fed story or rate story. You see more volatility in small caps because of their dependency on rates." She continued to say, "Investors usually see small cap stocks getting punished when there is a market sentiment that interest rates will stay higher for longer and recovering on signals that the central bank's monetary tightening cycle might be over." Concluding with a comment from Steve Sonic, again, apologize if I butchered the name, the chief strategist at Interactive Brokers, he commented, "That's why the extra volatility in small cap stocks over the past week should be characterized as an opportunistic rotation into a lagging sector as the mega cap tech lead rally has broadened out instead of a fundamental move into small cap stocks amid looser credit conditions or a strong U.S. economy. Small cap stocks move because the money is flowing into them as momentum carries the stocks along the way, but the downside is many stocks are unprofitable, which means they either need a strong economy or relatively favorable rates in order to borrow money and stay afloat until they can be profitable." Now, I have a question for you as we conclude the video. Do you purchase small cap stocks that are unprofitable and hence more risky in the U.S. economy, at least right now? Or do you look for small cap stocks that are profitable that can thrive during times like these? Let me know your thoughts down below, and thank you for watching Morris Money.